Hello there, viewers. Welcome to another exciting episode where we unravel the mysteries of the financial world. Tonight, we delve into the wild and wacky world of financial ratios. These ratios are the secret sauce that can make or break a business, yet they often seem as elusive as a cat in a room full of rocking chairs. Yes, those mysterious calculations that often make as much sense as a cat bringing you a dead lizard as a gift. They can be perplexing, but they are crucial for understanding the financial health of a company. Financial ratios can seem intimidating, like trying to decipher ancient hieroglyphics while riding a unicycle on a tightrope. But don't worry, we're here to make it simpler for you. But fear not, dear viewers. With a bit of guidance, you'll soon be navigating these numbers with ease. We're here to demystify one such ratio, the fixed asset turnover ratio. This ratio helps you understand how efficiently a company is using its fixed assets to generate revenue. By the end of this segment, you'll be tossing around terms like fixed assets and revenue with the confidence of a Wall Street tycoon, or at least with the confidence of someone who just successfully navigated a self-checkout kiosk. You'll understand how to measure a company's efficiency and make more informed decisions. Let's dive in, shall we? Get ready to turn those confusing numbers into clear insights. The fixed asset turnover ratio, in a nutshell, tells you how efficiently a company uses its fixed assets to generate sales. It's a key performance indicator that helps investors and managers understand how well a company is utilizing its investments in long-term assets. Think of it like this. It's like measuring how many pancakes you can make with a single pan. If you can make a lot of pancakes with just one pan, you're using that pan very efficiently. Fixed assets are things a company owns that stick around for a while, like buildings, equipment, and those incredibly uncomfortable office chairs. These are not items that are quickly consumed or sold. They are long-term investments meant to support the company's operations over several years. The higher the ratio, the more revenue a company squeezes out of its assets, which is generally a good thing. It indicates that the company is generating more sales per dollar of fixed assets, reflecting efficient management and potentially higher profitability. A low ratio? Well, that might mean a company invested in a really fancy panini press but isn't making many sandwiches. This could be a sign of underutilization of assets, which might lead to lower profitability and inefficiencies in the business operations. And nobody wants a sad, lonely panini press. It's a clear indicator that the company needs to reassess how it is using its fixed assets to ensure they are contributing effectively to generating revenue. Let's look at some real-world examples. McDonald's, the fast food behemoth, relies heavily on its kitchens and restaurants to churn out those Big Macs. A high fixed asset turnover ratio for McDonald's means they're flipping burgers and ringing in sales like nobody's business. On the other hand, a tech giant like Google, while needing offices and servers, generates a significant chunk of its revenue from intellectual property and software. Their ratio might be different, but that doesn't mean it's bad. Remember, comparing apples to oranges or Big Macs to search algorithms isn't exactly helpful. Different industries have different norms. Section 4. The impact making sense of the numbers. So why should we care about this ratio? Well, it gives investors and analysts a peek into how well a company is managing its resources. A high ratio can indicate efficiency and strong sales growth, making investors do a little happy dance. On the flip side, a low ratio might raise eyebrows. It could signal inefficiency, a need to reassess investments, or maybe the company just bought a really big boat instead of upgrading their factory. Analyzing this ratio, alongside other financial metrics, provides a fuller picture of a company's financial health. Section 5. Analogy time. It's like baking cookies, kinda. Imagine you're running a cookie bakery, delicious, right? Your oven is your fixed asset. The more cookies you bake and sell with that oven, the higher your cookie asset turnover is. You're a baking rock star. But if your oven is just sitting there gathering dust bunnies and disappointment, your ratio is going to be as flat as a day-old cookie. Not ideal. The point is, it's all about using what you've got to make some sweet dough, or in the business world, revenue. Section 6. In conclusion, ratios aren't so scary after all, maybe. We've journeyed through the world of financial ratios, and hopefully it wasn't as daunting as it seemed at first. There you have it, the fixed asset turnover ratio explained without the usual jargon and boredom. This ratio helps you understand how efficiently a company is using its fixed assets to generate sales. It's a valuable tool for understanding a company's efficiency and potential for growth. By analyzing this ratio, you can get insights into how well a company is managing its resources and planning for the future. So the next time you encounter a financial ratio, don't panic. Remember, it's just another piece of the puzzle that helps you see the bigger picture. Think of it like a puzzle to solve, or a cat to cautiously befriend. Each piece of information you gather brings you closer to understanding the whole story. And remember, if all else fails, there's always a good pancake analogy to make things clearer. Just like making pancakes, understanding ratios takes a bit of practice and the right ingredients. That's it for tonight, folks. We hope you found this session enlightening and a bit more enjoyable than you expected. Join us next week when we'll be exploring the thrilling world of tax deductions. Yes, you heard that right. Tax deductions can be thrilling too. Just kidding, we're never doing that. Good night. Until next time, keep those ratios in check and your pancakes fluffy.